welcome to Bloomberg Quint. I'm Agam Vakil and this is the earnings special on Tata Consultancy Services. We're just starting to get the earnings for this quarter and starting out with the bottom line. Well, the overall consolidated profit number is a little over 7,100 crores and that is certainly ahead of street expectations. But also the profit number attributed to owners is around 6,900 crores and that is also above street expectations because we were working with a Bloomberg consensus number of as much as 6,810 crores. We're awaiting more details with respect to your revenues, and there you have it. Again, revenues are looking at like a little shy off the mark, but for now we are looking at that profit number, which is largely perhaps a slight above expectations. And I think we have an IT analyst with us right now. We have Amit Chandra at HDFC Securities who's joining us on the phone line. Amit, what's your initial take when it comes to the top line as well as the bottom line? We're looking at the bottom line numbers at around 6,900 crores and your top line is at, actually we're still waiting for the top line numbers. But for now, when it comes to profitability at 6,900 crores, is that in line with your expectations?
Yeah, so now we were expecting 6,829 crores. So obviously it's higher than our expectation. And in terms of the top line number also, it seems to be higher than what we are expecting. So overall, the numbers seems to be strong. So we were expecting 2.9% growth in the dollar terms. So it seems to be higher than that. So
Amit, actually, we're getting news that the company has approved a bonus of 1:1, and they were also giving out a dividend of around 29 rupees per share. And I think this is something that will excite shareholders, because while we were expecting some announcement on the buyback, we really weren't expecting an announcement on the bonus. How are you reading this development?
Yeah, so obviously it's a very positive development, and typically all the large IT companies are working on the capital allocation policy, and the capital allocation policy last year also has been very favorable for the investors. So obviously, as Infosys also said that they're going to pay out 70% of the free cash. So similarly for TCS, we're also expecting favorable outcome for the investors. So obviously it's a positive.
Okay, Amit, actually the numbers for now largely look in line, and that said, what are you looking out for when it comes to verticals? What is your expectations, and perhaps what you're expecting from the management commentary when we have the management come and speak with us in the press meet right now?
Yeah, so we're expecting some kind of positive commentary on the BFSI, because BFSI was the vertical which they have been largely soft on, and also in terms of the margin guidance, as we have seen for Infosys, they have lowered the margin guidance based on investments in the US and hiring in the hiring on-site hiring. So based on that, we also we also expect that the TCS margins guidance could be a bit lower.
Amit, a word on margins. Operating margins currently stand around 25.4%. My question really is that TCS does give out the indications when it comes to the financial year. Would you be surprised if they actually wind down the margins by about 100 basis points when it comes to the margins range?
Yeah, we'll not be surprised, because obviously they have guided for 25-28%, and it was the margins that they're doing is at the at the lower end of what they're guiding. So maybe we're expecting that they can trim down the guidance. So it can be in the range of 24 to 25% EBIT margins. Yeah.
All right, Amit, and just one more question on the digital side of things. While we have seen, TCS sign a lot of large deals over the past 3 to 4 months, and it's also signed one of the largest digital deals as well in the previous quarter gone by. What can we expect? Can we expect this continuation of trend, or do you expect this to be largely lumpy as we move into the next financial year?
No, so we obviously see that the large deal wins has been pretty strong for TCS. So last year, like Transamerica, MGM, and like MNG Prudential, and you know uh, Nielsen deal win, like obviously provides visibility, and we expect the sizes of the digital deals to get larger. So that's a trend across the industry. Yeah.
Okay, Amit, we leave it at that. Thanks for joining us and giving us your view on at least the initial take on TCS. But we also have Harit Shah, who's joining us on the phone line. He's a research analyst with Reliance Securities. Harit, hi, thanks for joining us. What are you making of the TCS numbers, your initial take?
Yeah, so I think it was slightly, at least the revenue, on the revenue aspect, the revenue, it was a little better than what we were expecting slightly. Margins came in slightly lower than what we were expecting, and I think that's a very important, I think, figure to look out for in FY19. We saw Infosys guiding for a lower than expected range on account of investments needed to be made in the business, especially in on the digital side, on employee training in new areas like IoT. So I think we'll need to see what TCS has to say, whether would they guide for a lower band, or will it be 25 to 26%, what they were able to more or less achieve in FY18. So I think that is one key aspect to look out for. But I don't think there seems to be any issue, at least on the revenue front, as of now. So I think things are seemingly coming back on track overall for the IT sector, not just for TCS. So, again, we'll wait for management commentary before we make any further understanding about on this aspect.
Harit, please just stay with us. I do want to address the margins issue, but I think we have Sajid Mangat, who's joining us from the TCS headquarters. Hi, Sajid. What have you made of the numbers, and what do you have for us?
Okay, so from a fourth quarter point of view, you have a dollar revenues of $4.97 billion, which is up 3.9% quarter on quarter and 11.7% Y on Y. There is the board has also recommended 1:1 bonus share issue. That's what is coming in. The attrition rate at the end of Q4 is 11%, which they claim is the lowest in the industry. Digital revenue has crossed $4 billion, growing at 35% YOY. From an operating margin point of view, 25.4% is the operating margin, I think, which is pretty much in line with what the street was expecting. And they have come out with a total dividend for the full year of 50 rupees per share, including a 29 rupees per share final dividend has been proposed. So these are some of the key elements which are coming in. I'm trying to get the details P&L statement, which I don't have as of now, but these are the few things which have come up.
I have a question there with respect to the bonus. They have announced a bonus of 1:1, and this is a little bit of a change, and this is not on expected lines because we were expecting perhaps a large amount allocated to the buyback, but we really weren't expecting a bonus of 1:1. Do you think this changes the way the management is thinking right now? What according to you, is the thought process? And I'm asking you because you have been tracking this company for a very long time too. Okay, I think we have a problem with Sajid's line, so he will get back with us on more details. But, if I can take the same question on the bonus with Harit, if he's with us. Bonus rather of 1:1, and this is a little bit of a surprise. Harit, what do you make of this move? And is this a surprise? And can this also mean a substantial up move on the stock tomorrow morning?
Well, see, I think, as far as bonuses are concerned, nothing really changes fundamentally. It's not, as though they're, coming out of the buyback or giving, a higher amount of dividend. So I wouldn't say that this is necessarily some, one single factor that can move the stock. Yeah, it can obviously be a sentimental positive without a doubt, as, it could lead to, better liquidity and, maybe some sort of greater investor participation. But as far as fundamentals are concerned, nothing changes on that front. I think I would look out more for, obviously, probably something like what Infosys has been doing there. They are giving out, paying out an additional $2 billion, as far as, in terms of beat or dividend or maybe in terms of a buyback. So we need to see how, what is the cash return as far as this, the TCS is concerned.
Okay, so let me just, if we have Sajid back, let me put that question to him with respect to the bonus. Sajid, if you can hear me, the question really was about the 1:1 bonus. What do you think the management is thinking right now? Because this has been a little bit of a surprise. I was just talking to Harit right now, and he has suggested that it really doesn't change things fundamentally, of course. But well, this will be a little bit of a surprise. What do you think the management is thinking? And I'm asking you because you have been tracking this company for a while, Sajid.
The assumptions which normally is made is that the TCS is the biggest revenue generator for Tata Sons, which is the promoter company. And last year we have seen nearly $4.1 billion of cash being returned to the shareholders, including the promoters. This is primarily one way of increasing some bit of liquidity and also providing some kind of benefit to the shareholders. If you look at the revenue part, Agam, the revenue on constant currency terms has also come in, which is around 2%, which is slightly lower than what we were expecting. I think 2.3 is what we were expecting, and this is what we have received. 2% is something which has come in as of now. So that's something which I think you would need to get some reaction from the street on the revenue coming below the estimates.
Okay, Sajid, we leave it at that. Of course, we will touch base with you once we are also done with the presser. But if we do have Harit with us, Harit, coming down to the margins a bit, and as we were discussing, would you be surprised if TCS does revise its margins downwards? I think that you were trying to make a point there.
No, well, I don't think it would be surprising. Maybe if they say that margin will be flattish, then maybe it could be viewed as a positive. But see, as long as they say that it may be lower on account of some sort of investments that they're making, I'm okay with that, because at the end of the day that will lead to some benefit a few quarters down the line. So as we are expecting with Infosys, so I don't think necessarily that this will be too much of a negative factor. That is I think how the street would probably view it.
Okay, Harit, I have two more questions with respect to your expectations from the management once we have them come and speak to us. The first one is what you expect to hear from them when it comes to the different verticals. Now, TCS specifically has mentioned that they are in a wait and watch mode when it comes to the banking and financial space, and they've said that they are working with clients to figure out successive business models. And that said, what are you expecting in terms of commentary when it comes to the retail segment, which is the other big segment for them?
Yeah, I think that we need to get a better sense of both these verticals. Obviously, if you look at Infosys, for Infosys, both verticals weren't exactly very stellar performers, and outlook also is not necessarily all that sanguine. So maybe if TCS gives any different outlook, that will be quite interesting. We need to understand exactly why they would do that, because these two verticals seem to be right now undergoing some stress, and especially retail because of the Amazon effect. So I think I'm expecting it to be maybe a bit, not a little bit, subdued. That is what I'm expecting as far as these two verticals are concerned.
Okay, Harit, and my follow-up question was with respect to your expectations from the management was the digital side of things. Again, they've done okay, I think we do have the management coming in, so we're just going to cut to it and see what they have to say about the earnings.
Management team and the Q&A. Rajesh, can I request you to make the initial comments?
Good evening, everyone, and thank you for joining us. Welcome to TCS's Q4 earnings. I'm very happy to report a strong set of Q4 earnings to round off a turnaround year for TCS. We are glad to announce that we are back to double-digit trajectory on our dollar revenue growth, as we have been speaking about for the last couple of quarters. Looking at the numbers, Q4 revenue came in at $4.97 billion. That's a growth of $185 million of incremental revenue from Q3 to Q4. To put it in perspective, this is our highest incremental dollar Q4 in our history. And it is our third highest or fourth highest in across all quarters in our history. So we are very happy with the dollar growth that we have seen. It's coming on the back of strong constant currency growth of 2%, once again at the higher end of Q4 numbers. It's come through good volume growth. So volume growth in Q4 has been at 2%. We have had flat realizations, and we had currency helping us so that we went up to 3.8% on the dollar denominated growth. Our margin defense has been fairly strong. We managed to improve our operating margin by 20 basis points, and overall we have also, I'm glad to say, shared part of these gains back with our employee base, where we have announced 120% bonus for people on our quarterly variable payout basis. So the margin that the 20 basis point margin comes after 120% bonus payout. Net margins have come in very strong. We have crossed once again $1 billion in net profit margin, and I'll cover that in more detail in our annual coverage, but we are doing more than $4 billion of net profit for the full year. Cash from operations, it's been an outstanding quarter for cash conversion. So the profit conversion, cash defense has been very strong. We have done 122% is our conversion from net profit, and total cash generated has been close to 8,400 crores for the quarter. From a segment perspective, Continental Europe continues to lead the way. We are seeing very strong sustained growth momentum in Continental Europe. More encouragingly, UK, leading off from the strong deal wins that we have been announcing for the last couple of quarters, we are seeing strong growth in UK. UK grew by 10.7% year on year from a constant currency for Q4, that is Q4 to Q4. And Continental Europe has been at 19.1. Asia Pac has also come in fairly strong. From a IP perspective, from an industry perspective, as we have been reporting for the last few quarters, our mid-sized industry segments continue to drive incremental growth. Energy and utilities growing at close to 33%, and travel and hospitality going at more than 25%. Digital, which is an area that we have invested very strongly and very early on in the cycle, continues to drive growth for us. Digital revenues crossed 23.8% of total revenues. We now have more than $4 billion in annual revenue, not annualized revenue. Annualized revenue is closer to $5 billion from an exit rate perspective. That's driving on a Q4 to Q4 basis at more than 40%. For the full year, it's about 35%. Client additions continue strongly. We have added clients across all revenue bands with more than 3 customers added in the 50 million revenue band. The employee metrics is also very, very encouraging. We have added net additions of more than 4,000 people in Q4, and it is the highest net addition of every quarter in this year. So we are exiting with a very strong employee net addition. Even more encouragingly, our attrition continues to tick down as our investment and our commitment for organic talent development drives industry-leading retention across all competitors. Our attrition ticked down by 10 basis points, and we are now at 11% attrition on our IT services skill pool. Looking at FY18 as a whole, the year, as I said, has been a tough year, but encouraging year, a year that we are happy with the way it is ending and the way we have been able to execute on our strategies during this year. We are ending the year with rupee revenue of 123,000 crores, and in dollar denominated basis, I'm very glad to say that we have gone from 17.5 billion last year to 19.1 billion in FY18, which gives us a year-on-year dollar growth of 8.6%, which is better than what we were doing last year. We were at 7.2, so it gives us back on the trajectory of getting back to a full listing basis. On a constant currency basis, the picture is a little more mixed. We have reported 6.2 for the full year, coming from weakness in the early part of the year. But we are enthused by our upward growth momentum and trajectory coming over the last Q3, Q4. And we are confident about that momentum carrying through into the rest of into FY19. From an operating margin perspective, our reported margin for the year is at 24.8%. This is a 90 basis point reduction from our reported margin of 25.7 in FY17. Of this 90 basis points, 70 basis points is due to currency appreciation, and 20 basis points is coming from our overall operational elements. I would like to point out here that this 20 basis point is despite us announcing industry-leading wage hikes and doing the wage hikes from Q1 itself of last year. So it's post-sustained investment, both in our own employees, in digital, in reskilling, in localization, and in structuring some of the most innovative deals that this industry has seen. So I'm quite happy with where we are on our margin trajectory, and we continue to remain focused on getting it back into our preferred operating range of 26 to 28%. Cash from operations, again, it's been an outstanding year. We continue to improve our cash conversion ratio. We have converted 109% of our net profit into cash, and total cash from operations for the year is slightly above 28,000 crores. We have distributed 26,500 crores as dividend and buyback during the course of this financial year to our shareholders. We ran, as you know, the country's largest share buyback program last year, and the total payout has been approximately equal to the total free cash flow that we generated. In terms of customer metrics, it's been a phenomenal year. We have added 66 new customers in the 1 million plus range, with 13 customers added in the 50 million range and 3 customers added in the 100 million plus range. We now have at least 100 million customer across almost every vertical except utilities and travel, and both of those are very strong, and I'm sure we'll be adding on to that soon. Digital revenues for the full year came in at 21%. As I said, we crossed 4 billion in digital revenue for the full year, and it continues to be a growth driver, growing at 35% for us. From employee addition, we added about 7,800 net employees in this year, with an attrition of about the same 11% annualized that I spoke about. IP-wise, similar trends as in the quarter, not much to call out on, and similarly for the geography, the continental Europe being the standout performer, and UK coming back close to the double-digit numbers that we have been targeting. Happy to report that despite significant payout on our funds through cash distribution back to shareholders and a commensurate reduction in our other income, our EPS continues to remain positive, and EPS grew by 78 paise to 134.2 rupees. I want to take a few minutes now. These were the numbers. As I said, we are quite happy with the numbers, happy with the, the positive response that we have seen of our strategy from the market. And these numbers, as not just the absolute numbers, the trajectory that they are on, and the steady improvement that we are seeing, something that we are very happy about. I want to take the next few minutes to share with you some of the underlying elements of where this transformation and change is coming from. We have spoken about it at various points in time. I'm sure most of you are familiar with it, but I just wanted to take a couple of minutes to talk about that. Underlying TCS's transformation is its early investment in digital. And we have gone beyond just investment in digital from a technology perspective. And in the middle of last year in September, we unveiled what we call our Business 4.0 framework, which is our thought leadership framework which helps clients leverage the power of digital technologies to drive their growth and transformation agenda. And the deals that you're seeing and the transformation that you see is really ratification of the fact that this is resonating very strongly with our customers. We have said that in an industry where the general perception was that large deals are something of the past, we have proven that the largest deals can be structured if you have a breadth of offerings and you have the ability to integrate a large scope of offerings into client transformation agendas. So we are very, very positive about the power of this framework to drive our sustained growth. And it actually marries our core strengths, which is on the technology side and areas where we are investing in, whether it be digital, automation, cloud, agile, and takes that and marries that with key priorities with our customers on terms of the way they look at segmentation, where they are looking at mass personalization, their ability to leverage ecosystems to deliver this, their ability to operate at a significantly high what we call exponential value to their end customers, and our ability to participate in a global supply chain to make this available. You have seen this with companies like Amazon and others, where the price points on offer are unimaginable. The question is, how do you actually enable that for your customers to happen, and your ability and your will to participate in that? And finally, it is about our attitude to risk and the way we are able to embrace risk through analytics, intelligence, automation, to be able to make very, very calculated calls on where that risk is and how to manage that. So overall, we are very happy with where we find ourselves. It is, as I said, to some extent, a sobering thought that it is at both times a time of optimism, as well as the fact that it's a year where our growth has actually been lower than in the recent past. But the optimism comes from the fact that we are on the right trajectory and we are pointed in the right direction, and our deal flow, our deal wins, and the market outlook that we see gives us confidence that we are well positioned to deliver on the trajectory on double-digit growth. With that, I want to turn the floor over for questions.
Thank you, Rajesh. So we will start the Q&A, but just one request. Please stick to 2 questions. We want to give everyone a chance. And if you still have a question, we'll come back to you. So we'll start with Kritika from CNBC.
Thank you, Ashish. Gentlemen, congratulations for a good set of numbers. Rajesh, my first question is to you specifically on the segmental revenues. If you can give us a sense about the quarter-on-quarter growth that you've seen and your outlook specifically on BFS and North America. Are you still seeing softness in BFS North America? There was a possibility of volatility around the corner in Q1 and Q2. So keeping that in mind, can you give us a perspective on when we are expecting that return, and if NGS can also add to that from a larger perspective on how critical have these segmental revenues been from even the new deal win perspective as well?
So BFS North America continues to be an area that we are very focused on. I would say incrementally we are now more confident about BFS North America than we have been in the recent past, though the revenues have still not started flowing in. Okay. But early client discussions show that there is not much of stress left in the system, and we hope that that will translate into better spend through the course of this year. Okay. But I think Q2 will be a good quarter, or Q1, our financial Q1 and their calendar Q2 will be a good quarter to validate that. So we remain optimistic, but we'll wait for the next quarter to validate a uptick that we expect in BFS North America. The rest of the segments have been fairly as expected. Retail has been something that we are very confident about. What we have seen minor and I would say transient issue there, primarily coming out from some of the growth expectations and transformation that we have. But retail, we are very confident. We have the deal wins, we have the contracts in place, that we should see growth momentum in retail very strongly coming back in FY19. BFS is, we are optimistic, but we would wait for next quarter before we fully commit.
NGS, if you can add from a segmental perspective, in terms of new deal wins and the contribution there.
I think the tough gets going. So the full marks to our leadership team in BFSI. We are seeing some green shoots in BFSI North America, while there are still some softness we see. After discussing with our clients, we believe that it's bottomed out. And then as Rajesh mentioned, it should see growth in the coming quarters. We are seeing strong demand on digital, in securities, in blockchain, in analytics, data, and also we are competing in some of the large core systems replacement and transformation deals. So all this gives us the confidence that BFSI should grow. And on a year-on-year basis, BFSI grew 3.4%, with so much headwinds, if I can call it. So we are quite confident, but at the same time, we are approaching with some caution, right? Because there is still some softness left in the North America BFSI segment.
Okay, my second question to Ramki. Ramki, as far as margins are concerned, there is, of course, the aspirational target band that you have. Would you perhaps look at revisiting that, given the outlook that you have right now? Agreed that this time around it has been on target. And if you can also give us a breakup of the current margin figure in terms of the quarter and the annual figure, how have operational efficiency contributed along with currencies? And even utilization for that matter. Ajoy can add to that.
Okay, in the current quarter sequentially we had around 40 basis points. We got positive impact from the currency. We had about 20 basis points which was more from operational areas, but including we talked about we had a higher QVA in this quarter. So net effect from 25.2 we moved to 25.4 for the quarter. On an overall full year basis, as Rajesh said, we had 24.8 for the full year, and that had an impact of about 70 basis points from the currency for the full year. Maybe about another, last year we had our wage increases about 2% which had the impact, and the currency was 70 basis points. But against the 270 basis points which we had the headwind, we were able to recover almost 170 basis points through operational efficiencies. So from 25.7 last year, we had 24.8 for the full year basis. Coming to the outlook on margins, I think Rajesh touched upon a few areas. Number one, we came off a year where we had slower growth in two major sectors and also in the major geography. So we are seeing definite signs of that turning around, and with more the outlook improving on those, growth will automatically have that impact on our ability to drive more margins. Second is on the digital. It is continuing to scale, and we will see much more scaling. And with that scaling, we will have the opportunity to leverage all the operational advantages of scale in terms of bringing that. So coupled with both of this, we certainly believe that we are in the right trajectory, and we will continue to be focused on margins, and we don't see any reason to revisit any of those.
So that aspiration stays.
Absolutely.
Ajoy, if you can add to that as far as utilization impact on margins and even the attrition and how sustainable it is concerned.
Yes, from an attrition point of view, as we mentioned, it's about 11% as far as IT attrition is concerned, and we're pretty happy with it. And the primary reason is the kind of opportunity that we are giving to our people and the internal development of talent and the kind of digital deal wins that we are getting, and people are getting opportunity to work on newer technologies, the digital technology. So that's the way it's going on. And as far as the margin side is concerned, we have been very disciplined in our execution. Okay, so utilization is a number which probably we need not get into as to percentages. And because we have not been publishing it for a while, it becomes difficult as well. So what you need to look at is the way we have been adding resources, which is about 7,700 is what we have added in this whole year. And it's each and every person is actually deployed in engagements, or they're getting trained, getting ready for the future assignments. So it's been run as a very disciplined ship. So that is what we are focused on.
Thank you.
Thanks, Kritika. The next question is from Swati.
Hi, gentlemen.
BTV.
Thank you very much. Swati Khandelwal from Business Television India. First and foremost, what is the mix of higher value project segments and revenue per employee trend that you're seeing, Rajesh? That's one question. And also the strategy to mitigate impact of US tax code, if you can help us understand and give your views on it.
See, the one way to think about it is that digital as a percentage of revenue is 23.8. We don't break out service lines beyond that. Typically, digital comes in at a higher price per person kind of a point, and it also comes with a higher on-site centricity. But as the scale increases across some of the smaller sub-segments of digital, we expect to see leverage increase over time. Beyond that, I think it's more about our focus is about consolidated structures rather than individual service lines. So as I have explained, the reason we have been able to stitch together large deals is because we are looking at it as a holistic offering rather than point solutions for a website here or a mobile solution there. And it's our ability to put this holistic solution, which gets all the way from a legacy backend to a absolutely modern front end, is where the deal structures are. So the deals that we are announcing are really combinatorial deals rather than individual point solutions.
Okay.
Yeah. On the, we don't comment on country-specific issues, but let me give you a perspective on our overall effective tax rate, which is finally what it translates to. So last year we had about 23.6, that is the FY17. FY18 we closed at 24.1 on an effective tax rate. So going forward, we expect that to go up a little bit, and we will stay within the 24 to 25 range for the effective tax rate.
Okay, and my second question is the wage hikes that are planned in FY19 and impact on margins. Mr. Ramakrishnan, or
wage hikes, we have already given the wage hike. Just like last year, every year we do it from 1st of April. Yeah. And wage hike this year has been between 2 to 6%. It varies from country to country, right? Average will be at different levels, 2 to 6%. So. And the individuals will get more than that. So for example, the high performers will get more than that. So like that it goes on. And it's effective from 1st of April onwards. And in addition to that, I think Rajesh announced in this thing that the variable payout that we are doing, as far as the Q4 variable is concerned, it is at 120%. So which is over the last few quarters, we have not been giving more than 100%. So this is for a while. I think this should go pretty well with our employees as far as the variable payout is concerned.
And the impact on margins of the same?
The margin impact will be very similar to what we had last year as far as on the operating margin is concerned. Yes.
Right.
Thanks, Swati. Sajid from Bloomberg.
Hi, Rajesh. Couple of questions here. Your revenue for the full year, you grew 6.7% on constant currency terms, and roughly around 8.6% on normal currency. Is this growth rate of 6.7% constant currency is the new normal growth rate for TCS going forward? The second question to you, the second one to you is about capital allocation. You had given $4.1 billion to shareholders last year. What is the plan for capital allocation for FY19 is concerned? As for Ramki is there, you mentioned that you expect margins to be in a stable range. If you can define what is that range going to be, and now that you have embarked on TCS Business 4.0, where you may require to do more investment in skilling and going to market and other, will that mean that there would be a shift in the band down as far as margins are concerned?
Okay, let me say that if it was to be 6% as the new normal, it would be a very boring job. So we are committed to going on the 10% trajectory. In Q3, we were around 6. Q4, our year-on-year constant currency growth is 7.2. As I said, the dollar growth is 11.7. We are committed to try and get it up to that double-digit growth. And that's where the entire focus is. That's where the complete, we believe that that's possible. And we're committed to doing that. What was the second question? Capital allocation, we have always said that we've been, if you look at our history, we've always believed that about 80 to 100% should be the distribution. This year, that is, it depends on whether you look at it as a financial year or a calendar year. We have distributed 100%. We generated free cash flow of about 26,500 crores. Between dividend and share buyback, we have distributed about 26,500 crores. We expect similar kind of 100% distribution going forward also. And even more importantly, we are very committed to across multiple stakeholders in our shareholder community. The bonus declaration also is more focused on our smaller and retail shareholders whose preferences for those kind of float related ones. So we are very committed to it. 100% distribution is where the focus is.
Yeah, I think on margins, current year 24.8, but if you take currency around 25.5, so that is from investments. We have been always making those investments, and we don't give a guidance. You are aware of that. Yes, stable. I mean, in the sense that what we have, if you look at last year, we have been in that range of around 25%. Our aspiration is to do higher than that. And I also talked about growth feeding into higher potential, plus also the scaling on the digital. But your second part of your question with regard to investments to be making into digital, we have been, in the last 3 to 4 years, we have been making those. And we'll continue to make those. And whatever the stability, etc., you have seen in the margins is on the back of some of those investments. So we don't see anything extraordinary about that.
Thanks, Ajit. Neha from Money Control.
Yeah, hi. I just want to understand, you said Asia Pacific also did well apart from continental Europe and the UK. Could you just talk a little bit more about what your strategy is going to look like in the year going forward in Asia Pacific specifically?
Asia Pac, we have a fairly broad-based strategy in Asia Pac, participation across all key markets. We've been very strong in Australia. We continue to build out on our leadership status in Australia. As you know, we made a strategic investment in Japan, and that investment is going well. I'm glad to report that this year, Japan has also delivered double-digit growth, and on a stable margin front. Similarly, we participate across the ASEAN region also. ASEAN is a smaller footprint for us, but we are committed to that region. And technically, that's we run our APAC operations out of the ASEAN region. So Malaysia, Singapore, we are very well established. I would say we see very strong growth prospects coming out of APAC region. But it's a very diverse kind of market sets between Australia, Japan, and ASEAN. And we are really focused on attacking each market in its own different forms.
Well, that's the management of TCS. To take you through the numbers, well, it's been a very good quarter for TCS. We were expecting a steady quarter, and what we've got is at least the headline numbers coming ahead of consensus expectations. Starting off with your dollar revenues, we're looking at an uptick of around 3.9% at a little less than, well, I would say, well, $5,000 million. That's around $4,972 million to be precise. Coming down to the rupee revenues as well, that's seen an uptick of around 3.8% at a little over 32,000 crores. Its EBIT margins coming at an expanded 25.4%, about a 20 basis points expansion, nothing too much to speak for. But once again, because of the fact that we've seen a beat in the top line, we're also looking at a beat in the bottom line. Consequently, looking at a 6% growth on a sequential basis at 6,925 crores. The big surprise, of course, however, which could improve sentiment in the stock, will be the bonus issue of 1:1. The company has also announced a dividend of 29 rupees per share. So these are some of the positives. On the whole, if I'm looking at several of these performances when it comes to its verticals, well, when it comes to financial services, there's about a 0.4% growth. But what we've also seen is a little bit more consistency in the retail segment. It's shown an uptick of around 0.8%, and that will be a positive, considering we've seen a negative for something like an Infosys. And energies and utility segment, again, one of the relatively larger verticals, has seen an uptick of as much as 6.9%. The management is being very, very confident when it comes to Europe, especially something like continental Europe, which has seen double-digit growth, and UK continues to show strength. On the other hand, I'm not too so sure if the management is very confident about their uptick in North America, and that's where you have majority of your revenues, in fact, more than 50%. So, well, that said, again, the management is saying that at least through their client conversations, that particular geography just may have bottomed out, but we don't know that for sure, and we will have to wait for another couple of quarters before that comes through. On the whole, a very, very good quarter for TCS with a bonus of 1:1 and of course a dividend. So that's what we have in terms of TCS's earnings, and of course we will keep bringing you more details, but for now we're expecting the stock to open in the green based on these numbers. But don't go anywhere, lots more lined up, so stay tuned in a Bloomberg Quint and we'll keep bringing you more.